Hello, friends. I'm Ashwini, your host for this latest edition of Market Perspectives at Emkay Wealth. Welcome, Dr. Joseph. How are you today? And what is the state of the markets?
Good to be here. Thank you very much.
Let us stick to fundamentals. What is that single strong factor which provides fuel to domestic financial markets? I mean both equity and fixed income.
Yeah, if you want me to choose one of the strongest factors out of a number of factors which are at the moment influencing the markets, the market levels, and also the performance of the markets, it is liquidity. There is plenty of liquidity in the interbank market. The interbank market has a surplus of close to 1.5 to 2 lakh crores. And there is going to be more liquidity coming in because of the CRR cut by the Reserve Bank of India. It will take its full effect before 30th of November 2025. The 1% CRR cut is expected to add about 2.25 lakh crores to the liquidity in the system. So the liquidity conditions in the markets is excellent, and the liquidity dynamics for the domestic markets has completely changed, with 35,000 crores of money through SIPs, through mutual fund route flowing into the equity markets every month, month after month. And also with the inclusion of Government of India bonds in the JP Morgan Emerging Market Bond Index, there is a good amount of liquidity which has already flowed into the bond markets as well. So liquidity is the defining factor as far as the markets are concerned at this juncture.
Do you expect the liquidity to continue at the same levels, or would it be RBI drain it out and some point in time?
RBI may not drain out liquidity at this juncture. It's possible for RBI to drain out liquidity through reverse repos at any point of time. So RBI has so many instruments at its disposal, but we expect RBI to continue to keep the liquidity conditions smooth and stable, especially in the light of adverse international conditions, like we have the cloud of uncertainties coming from the Trump tariffs and a lot of other related things, including the visa issues and all that. In such a situation, generally a central bank combats such situations through easy liquidity. If we look back during the COVID time, the RBI had injected a significant amount of liquidity into the markets. So liquidity is an instrument at its disposal, and I think they will use it. And at this point of time, we need liquidity. Therefore, RBI may not take it away from the system at this point of time.
Okay. There is significant moderation in inflation going by the recent numbers. Would this be a consideration for RBI policy making?
Yes, low level of inflation is definitely one of the factors which RBI considers when they formulate the policy. And inflation, the latest CPI number was at 2.07%. The latest CPI, it's quite low. Though RBI has projected the inflation level to be close to 4%. In our assessment, it will be somewhere in between 3% and 4%, which means that inflation will be under control. But for the RBI, the major policy, the factors which they would consider, one of the major factors which they would consider would be is there going to be any adverse impact on the rate of economic growth from exogenous factors like the tariffs and things like that. If RBI finds that Trump tariffs or related issues are going to pull down the growth substantially, then RBI would step in and would even cut the rates and inject more liquidity to support the economy, which would indirectly bring in support to the markets too. So the prime consideration at this juncture for the RBI would be growth, rate of economic growth, GDP growth, and any adverse impact the exogenous factors may have on the economy is something that the RBI would be looking out for. Yet another factor which RBI governor mentioned in his RBI policy statement is that they are still awaiting the picture relating to the full impact of the rate cuts already done. They have already brought down the repo rate to 5.5% and a 1% CRR cut has also been given, and they are yet to assess the full flow and impact of those measures on the economy especially the banking system, credit growth, lending rates, etc.
Are the domestic markets looking expensive? What does it look like on a relative basis with other markets?
Other markets, if we look at it, China trades at a much cheaper valuation. That's because that's where that market should be. China always trades maybe 30-35% at a discount to the Indian indexes. Yet another cheaper market would be Europe. There has been no growth in Europe. But there is potential for growth to come back into European economies, because a couple of months back the European nations had a defense summit at Munich, and in the Munich summit they decided to increase or enhance their defense spending to about 6.5% of the GDP. Earlier it was only 1.5 to 2% of the GDP. They are pushing up the defense expenditure because of these specific conditions prevailing at this point of time, especially in the Russia-Ukraine war and all that. So they are jacking up the defense spending. So that's going to give a push to the European markets. And at the same time, Europe is trading at a relatively cheaper level. China. As far as the US is concerned, if you look at because the US markets have been on fire and the markets have been going up all the time. If you're looking at indexes like the tech index, like NASDAQ and all that, the PE is around 38 at this point of time. Whereas it's mainly because of AI related and also the smart chips push. But when it comes to the domestic markets, if you look at the Nifty 50, the PE is at around 22.30 levels, which is slightly above the long-term average PE. So we need to understand the specific conditions in each economy before seeing whether it is expensive or it's cheap. As far as India is concerned, India is structurally tuned to grow at 7%. The GDP growth which India is structurally tuned to give the economy is around 7%. Even with the tariffs and other exogenous factors, it may be pulled down by 0.5% or maybe 0.75 basis points, in which case it will be 0.5% this way or that way around the 7% level. So India is one of the fastest growing economies and it's going to be the third largest economy. So if you're looking at the growth potential, then I think our markets are fairly reasonably valued.
In the equity space, what should be the market cap positioning? There is a widespread feeling that the mid and the small cap space is expensive. What is the basis for a continuing tilt towards mid and small caps?
There's a tilt towards small and mid caps mainly because of 2-3 factors. The first factor is that a lot of money which is flowing into the markets, especially through the systematic investment plans, through the mutual funds, is going to mid-cap and small-cap funds. So that liquidity is to a large extent moving into small caps and mid-caps. A second factor which is very fundamental to the markets is that the potential for growth, business revenues, and therefore business earnings. The potential for that is the highest in the mid and the small cap segments because they have much better governance standards at this point of time. Most of them are a large number of them are into businesses which are going to do very well over a period of time. And so if they are going to grow at a much better rate compared to large caps which have an established business model, then their prices would also reflect. the business growth and also the earnings growth. That will get reflected on the exchange in the prices of mid caps and small caps. But at the same time, one must be cautious about it that stock picking is very, very important when it comes to mid caps and small caps. Therefore, we need to look at very good managed products supported by very good research. Yet another factor which gives a fillip to the mid and small caps is the fact that their market caps have expanded. This market cap expansion is because of liquidity, number one. The second thing is that when, like in any other commodity, even as far as equities is concerned, supply-demand factors are relevant. So it is a very well accepted theory that the supply and demand, supply of a stock and the demand for a stock would determine its price like any other commodity. So it's a theory which has gained a lot of ground. Now, because the market caps of mid caps and small caps have expanded, mid caps are any stock with a market cap above 99,000 crores and small caps are now at anything from 9,000 crores to 34,000 crores. It means that even if FIIs bring in some money, a few thousands of crores into mid caps or small caps, they can easily deploy it in these stocks because of the expanded market cap. So it's not that they bring in 2,000 crores or 5,000 crores and then they end up buying up a few companies, because earlier, maybe a few years back, the market caps of most of the small caps used to be 750 crores or 2,000 crores, etc. Now the definition itself is from 9,000 crores to 34,000 crores and 34,000 crores to 99,000 crores. So they have a potential to grow, therefore better earnings and better business performance and therefore better price performance on the exchange. Market caps have expanded, which facilitates even external investors and domestic investors to put in more money because of the market cap expansion, despite the relatively higher valuations. So as I had mentioned earlier, we need to look at the supply-demand theory at the end of the day, that because some sectors have very high PEs, some market caps may have very high PEs. It's because of the peculiarity of those sectors and segments that the high PEs are sustained or are looking sustainable.
Okay. Despite the distraction created by the tariffs, what are the three strong factors that would propel the equity markets higher?
Yeah, liquidity I have just mentioned as one of the strongest factors which will propel the markets to much higher levels. The second factor which we have always been looking at is the public capex of the government of India. In the last 2 years, it has been around 11 lakh crores. And even in the current year's budget, it's at 11 lakh crores. And that's the public capex of the government of India. So that public capex goes in the form of orders to various companies like Hindustan Aeronautics Limited, Siemens, L&T's and all that. And those orders are also converted into orders for those who manufacture components and parts, etc., which are downstream companies. So we believe that it will be one of the strongest factors which will support the companies and therefore the markets. Now, according to some of the estimates available, about 40% of the public capex has been expended so far, which means 60% of that is still to come into the markets. So that will happen over the next 6 months. There is sufficient time for government to spend that money. So this is one of the strongest factors which will give some support to the markets. Now, is there any other reason why it is important for the markets apart from the private capex? As per a survey organized by the government of India, the Reserve Bank of India, the private capex was going to be lower compared to the original estimates to the tune of about 1 to 1.5 lakh crores against the original estimate, which means that the private capex to be maybe to the tune of maybe 2.5 to 3 lakh crores. So earlier it was projected to be around 4.5 lakh crores. So there is a deficit there, or there is a deficiency there. So this public capex will more than make good that deficiency even in the private capex. So far, as I have mentioned earlier, only 40% is expended. There is more of about 60% is yet to be expended. So that is a very strong factor apart from liquidity, which will propel the markets to much higher levels. Yet another factor which we consider as very important even for the equity markets is that the recent GST cut, which leads to a gross revenue loss of about 1 lakh crores to the government of India, will have a multiplier effect as far as consumption is concerned. Consumption is going to pick up because the consumers will respond to a reduction in the GST, and there will be higher spending, and it will be a multiplier of the revenues which the government is foregoing on a gross basis. It's 1 lakh crores. Eventually, the impact of this revenue foregone of 1 lakh crores and GST reduction will be 2 to 3 times of what the government has foregone. So we will see the impact over the next 3 to 6 months' time. It will support consumption, and it will incentivize discretionary spending. Second thing is that in the budget, the government had given some concessions on the income tax for people in the lower income tax brackets. The totally positive impact of that over this whole year is going to be something like 2 lakh crores. So the GST reductions plus concessions on the income tax, apart from all these things, we have the PLI for the manufacturing entities. All these things coming together, one could have never asked for a better governmental action in view of all these factors, including supportive liquidity, lower interest rates, for the equity markets to do well. So once the cloud of these tariffs gradually wanes away or fades away, then the markets are going to move up quite fast. These are some of the factors which we consider as 3 factors. You asked me for 3 factors. I think I should not mention more than 3 factors. So these are the main 3 factors which are coming to my mind at this point of time as far as equity supportive factors are concerned.
Sure. I recall that in your July interview with the ET markets, you had stated you found corporate bonds favorable. What should be the ideal positioning in the fixed income space with a 2 to 3 years time horizon?
Yeah. As far as, because if you're investing into bond funds or gilt funds or any other debt funds, there are 2 things that are fundamentally important for you. One is the duration risk. The other is the credit risk. And as far as the markets are concerned, say for example, if we are looking at the 10-year benchmark yield, the current 10-year benchmark yield is at around 6.5%. So the benchmark yield is range bound, around 645 to 655 is where the 10-year benchmark is trading. So it's a very narrow range within which it's trading. So we may not be able to see any major movements either way. On the gilt yields are not going to move up too much, nor are they going to go down too much. Only if they move either way, there will be some possibility of making some gains as far as portfolio is concerned. Second thing is that so long as they are remaining range bound and the potential for a rise in interest rates, at least in a feigned form if it exists, the best avenues to invest into would be where there are higher accruals. And higher accruals are possible at this point of time in good corporate bond funds, which may have 7% plus portfolio yields, YTMs, and also good credit risk funds. They are very good credit risk funds, which we have selected using our enhanced efficiency model, which are very well managed credit risk funds. They have a portfolio yield of close to 8 to 8.25% is the portfolio yield. It makes immense sense moving selectively into well-managed credit risk funds at this juncture to capture the accrual benefit for the portfolio for the next 2 or 3 years. Okay. That's broadly our suggestion, and we wouldn't suggest any investments into duration funds. If you're already invested into gilt funds, We had given a call for exit around 615, 620 levels to exit from gilt funds, because we felt that the movement in the 10-year benchmark yield had bottomed out at around 615, 620 levels. Then it reversed towards 6.5%. So we do not see any major movements at this point of time, favorable movements of yields moving down, unless RBI comes in and then cuts the interest rates or repo rate to support economic growth. That also may not lead to any major favorable movement in the market. So stick to good accrual portfolios, which may be corporate bond funds or credit risk funds, and maybe good credit opportunities funds, which may require the investor to stay invested for 4 or 5 years.
Okay.
But the corporate bond funds and the credit risk funds have a relatively shorter duration. And therefore, that would be a better play as far as portfolios are concerned.
The rupee has been much weaker at rupees 88 against the dollar. What are the factors at work? What is the direction of the exchange rate?
Yeah. See, as far as the dollar rupee exchange rate is concerned, today it's at around 88 rupees 60 paise. And what supports the dollar rupee exchange rates, or what pulls it down is just two factors. One is trade and the other is investments. As far as trade is concerned, we know that there is an adverse environment globally because of the tariffs and things like that. Even otherwise, our trade has been a very minuscule portion of the entire global trade. And trade is never going to support the rupee at this point of time unless our exports are going to grow and they are going to be higher than our imports. We are net importers, which means we need to buy dollars to pay for our import of gold, import of crude oil, import of edible oil, import of gems and jewelry. So many imports that we are doing. Net, we need to pay dollars, and that dollars, which means that there is no way trade is going to support the rupee. Therefore, the rupee keeps on weakening all the time. The only times when the rupee strengthens is when we get good inflows from FIIs. When FIIs bring in some money into India, they sell the dollars and buy the rupee. So that's how it works, and so the rupee strengthens with it.
Okay.
So at this point of time, we do not see any immediate potential for FIs to come in. Though if you're looking at the last couple of days numbers, there is some net FI monies coming in. Our view is that FIIs will come into India and emerging markets. That will happen only when the Fed would cut the interest rates further. Because Fed has so far cut the base rate, the Fed funds rate, only by around 125 basis points. Our view is that the Fed will cut the Fed funds rate to the tune of about 2%. So 200 basis points. So there is another 50 to 75 basis points rate cut that's likely to happen in the US because of the concerns around economic growth. So usually what happens is that whenever the Fed funds rate comes down and US interest rates gradually move down, a lot of monies which are chasing high risk investments, high return investments in emerging markets, they move out of the US and come into the emerging markets. So we may have to wait for another 1 or 2 rate cuts in the US before we could see FIIs coming into the domestic markets. They have all the reasons to come into India because now the rupee has depreciated to 88, 60, 70 levels. That's a very good thing for them to bring in their dollars. They get more rupees. The second is that no economy in the world is going to grow at around 6.5% to 7%. Stable. The government finances are in excellent shape. Government will stick to the fiscal glide path by containing the fiscal deficit. The government finances are in very good shape. Government is not going to borrow anything extra in the coming year, despite the tax revenue losses on account of the GST cut and also the income tax cut. But at any point of time, if they get a generous dividend from the RBI, that will more than make good whatever revenue losses that they would make on the tax front also. So government finances are in very good shape. And we are negotiating trade treaties with a lot of other countries. So that's where we are in terms of the FIIs coming back and the dollar rupee position. And rupee will, say for example, based on fundamentals and over the medium to long term, rupee is likely to slide further.
Okay.
But from the current levels, if you are looking at it, say for the next 3 months, if you are looking at it, there is a likelihood of the dollar rupee exchange rate gradually moving down towards 87, 60, 70 levels as a first support, and a little later to 87, 20, 30, because these two levels were strong resistances when it was moving up. So as we get some inflows and all that, the potential for dollar rupee exchange rate to move towards these levels, but this is something that could happen over the next 3 months. That's our view at this point of time.
Coming back home, Emkay Wealth has been recommending gold and silver for a little more than a year now. Are the recommendations on both gold and silver remain good still? Are there any risk, Dr. Joseph?
Yeah, we had put out the recommendation on both gold and silver about a year and a half back, and we have been quite conservative in the levels that we had forecast as far as the target levels were concerned. So both in gold and silver, we had revised our levels upwards towards the all-time highs or towards technical resistances. Now both gold and silver have a peculiarity in terms of their price movements and price actions. They move into very long phases of consolidation, and those consolidation phases generally last for around 7, 8 or even 10 years. Both gold and silver, when they move into a consolidation phase, the prices move down a little bit and then they are in a consolidation phase for a very long time. This is observed from the price action for the last 100 years and for the past 20 years. If you look at the charts, it's very evident that consolidation phases are very long. Second is that whenever they are in a booming phase, when the prices are moving up, that also lasts at least 6-7 years. The boom continues to be for 6-7 years. And in both silver and gold, we have seen the upward movement in the prices over the last 2 to 3 years, which means that probably we are only halfway through the uptick. This boom phase is only halfway through, because we are into only 2 to 3 years now. What about the rest of the 6 or 7 years? It's yet to come. So based on past price action of the last 100 years or 20 years, something that we can infer is that they have come out of the 8 to 10 years of consolidation phase, both gold and silver, and now they are in a phase where there is a boom phase. And boom phase is now only into 2 to 3 years. Generally, these boom phases continue for 6 or 7 years or even more. Okay. That's the observed price behavior, which means that even the current up move may last longer, more than what we have seen at this point of time. Gold is at $4,000 roughly, and silver is at around $47, $48 at this point of time. Quite a bit of the gains for the domestic investors would come from a weaker rupee also. If the rupee strengthens a little bit, the domestic prices might come down. But as far as the overseas market movements are concerned, there are two factors that we need to factor in. One is that if the US interest rates are going to come down, then we will see a weak US dollar. We'll see the US dollar gradually declining or losing value against currency majors. That is one factor. When the US dollar loses some ground against the currency majors, in such a declining phase, this decline in the US dollar gets reflected in the prices of all commodities which are quoted in US dollars. So that is also one of the factors that the prospects of lower US interest rates, the prospects of potential for a weaker dollar, these are two fundamental factors which are going to influence the direction of gold and silver prices in the coming days. And the potential for those two events to happen is very high, which means that we could see further upside for both. But we need to be very careful in the sense that the allocations in the portfolios, generally we do not recommend more than maybe 5 to 10% allocation to gold and silver in the investor portfolios. So that's also one of the measures by which you stay invested in gold and silver. Gold can be held for many years to come. Silver has an additional advantage that it has a lot of industrial uses like solar panels and EV chips and all that. They all use silver. So the supply of silver is sufficient to meet the demand for silver at this juncture, because we had forecast the supply demand balance at this point of time. So the supply is not good enough because the dependence on scrap silver for fresh silver to use in various, including jewelry and industrial uses, has risen, which means that there is not enough exploitation that's happening in the mines, or that the mines do not have enough to supply. Therefore, but as far as silver is concerned, silver is maybe 8 to 10 times more volatile than gold. So therefore, if you are investing into silver, you should treat it as a kind of a tactical allocation where you enter at some particular levels, and then you should also predefine certain levels of returns where you would exit. So we have captured all this in the MK Wealth Navigator, month after month, both gold, and there's a very nice write-up titled The Silver Lining. So one should read that, and every month we have been covering that and also giving the recommendations on that front.
Enriching analysis and deep insights. Always fulfilling conversations with you, Dr. Joseph.
Thank you very much.
Thank you for being with us today.
Thank you.
And thank you everyone for watching. Stay tuned for more on markets, investing, portfolios, growth and success. Please do like, comment and share. Drop in the comments if you have questions for us or for Dr. Joseph, and we will get back to you. Until then, wishing you a bright and delightful festive season. Shubha Deepavali to everybody.
Happy Deepavali. Happy Deepavali.
Thank you, sir.
Thank you.
Thank you.